Hello, in this video I am going to cover the difference between an interest only and a repayment mortgage. So if you've got a mortgage on a regular residential house, basically a house that you live in, then you'll know that you may not know. So if you don't know, then check out the difference between interest and principal. I've got a video covering that. But basically, if you borrow £100,000 from the bank, it's a very simplified example, and it is, so that's the loan, and let's say the term, which is the length is 10 years, and so that means it's £100,000 divided by 10 years gives you £10,000 a year repayment, but then you also have interest on top of it as well. And again, I'm just going to keep it simple and say there's a flat interest amount per year. So let's say interest, you can usually have a percentage and that's based on the principal left, but I'm going to keep it simple, and let's say it is £2,000 a year. So £2,000 a year, so in total per year you'll be paying 2,000 messed up there. 2,000 plus the 10,000, which gives you a grand total of £12,000. So interest only versus repayment, pretty simple. Interest only, you would only pay the actual interest itself. You're not paying down the mortgage. With principal, so with a with a repayment mortgage, you are paying down the principal. So that is the amount borrowed over the term, and obviously that would be the amount per year, and then you could divide that by 12 to get the amount per month, for example, plus the interest as well. I'll do this in a different color. I'll do this in the green, plus the interest as well, so which is obviously this and this, and all of this is basically this number here. So ultimately what the difference comes down to is this: if you do repayment mortgage in this scenario, repayment after 10 years, because that's how long the mortgage is, it could be 5, it could be 25, it could be 35, the principal is the same. After 10 years, the house is, or it could be a house, it could be a flat, I'll say property just not to confuse anyone thinking is this different for flats. Same principle. The property is debt free, and assuming you haven't remortgaged or taken out any loans on the property in the meantime, debt free, and you 100% own it. That's obviously fantastic. Owning a property, owning anything 100% is obviously sounds pretty good. If you do interest only after 10 years, those 10 years are still going to go by regardless of whether you do interest or repayment. The interest is paid, the repayment, the principal, so which is the loan amount, the principal is outstanding. So the principal is outstanding and that needs to be paid. So you can do that in either one of two ways. You can either remortgage and then you go through the same process again. You could just do interest only, and because that gets paid off via the remortgage essentially, or if you have the cash, pay it off. Obviously £100,000 is a lot of money for a lot of people, so they may not have it. So you might be thinking, why would you do interest only over repayment? At least with repayment at the end of it, you own your property. But think of it like this: in the scenario above, though it's a simple one, in the scenario above, it was the difference of £12,000 per year versus £2,000 per year. So that difference equates to, do a different color, £10,000 a year. And if you go interest only, which is very common for investors buying stuff like HMOs, buy to lets, that sort of stuff, they would usually do interest only, and then use, or at least the smart ones will use the balance, the difference between interest only and repayment mortgages to invest in other properties, make improvements to their properties, or invest into other asset classes as well, like stocks and potentially cryptocurrency. Whereas with this method, you can't do that. Obviously, you could use extra money, but that 10,000 is sunk into that property. And yeah, that's it. With residential mortgages that you would get on a property that you live in, flat, house, doesn't matter, they typically are repayment. For the simple reason, banks generally will only give you repayment for the most part. Plus, on top of that, it's for the the person who's borrowing the money. It's a sense of security that after this is done, and I'm like in my 50s or 60s, for example, I'll retire and the property is paid off. So that's basically it. So using the interest only method, you can use that money to invest. For example, that's one of the things that you can do. You can invest in improvements into the properties, maybe extensions or renovation. You could save it up and put deposits down on more properties and invest in other asset classes. The other thing to bear in mind, this will vary country from country and depending on when you're watching this video, but as of now, I'm recording this video on the 1st of June 2021, but as of now, interest, this is for a business, interest is tax deductible, whereas the principal portion of a repayment mortgage is not tax deductible. So that also makes a difference for investors as well. So that's the difference. Repayment mortgages, you pay off the interest and you pay off the original loan amount. So at the end, if you haven't remortgaged it or taken out any more loans on that asset, you have it 100% owned to you. You don't owe anyone else money on a regular basis. With interest only, you only pay off the interest, and at the end of the term, so in this case 10 years, there's a balance outstanding and something has to be done about that. So that's it. That's the difference between the two. If you have any questions, feel free to join the Discord group. There's a link in the description, and there are finance channels as well. So thank you for watching, and I look forward to seeing you in the next video.